Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com. Welcome back, Clark. We have another episode of our Lockshield podcast, and today we're going to talk about something that affects a lot of people and almost all or most retirees: Social Security.
Heard about it.
Yes. And for 25 years, I've been hearing that it may not be there when I retire. And who knows? But from a planning point of view, we're going to go on the assumption that it is there. So how about if you set the table for us? Tell us, give us a little bit of background.
Yeah, let's take a dive back into a history lesson. So the first Social Security benefit was paid out in January of 1940. So 85 years ago.
How about that?
The happy 85th anniversary to the Social Security Administration. But it essentially started as what it is now, a way to help Americans with retirement income. And really what goes hand in hand with Social Security is Medicare. Yep. Medicare wasn't introduced until a little bit later, until the 1960s, but it's exactly what we all know it to be. It's a supplement or a starting spot for our retirement income.
What we used to call the three-legged stool, or we still do, the three-legged stool of retirement planning. Social Security was one of those. Pension, which there aren't many of those left around. And then savings.
Right.
So we're gonna talk about one of the three-legged stools.
Absolutely. So Dan, so you mentioned the funding of Social Security.
Yeah. So who pays for it and how do they pay for it?
Well, we pay for it.
Of course we do.
You and I pay for it.
Of course we do.
So everybody in the U.S., whether you realize it or not, you pay what are called FICA taxes. So if you take a look at your pay stub.
Who is that guy?
Yeah, who's that guy? You'll see probably two different line items on there. Could be one, but two different line items for Social Security tax withheld and Medicare tax withheld. So everybody in the U.S., 15.3% of your income, of your gross income, goes towards Social Security and Medicare.
That's right.
The employee pays half, and then the employer pays the other half.
And if you're self-employed,
the IRS considers you to be the employee and the employer.
You get to pay both halves.
You get to pay both halves. And that does, for those people, create a cash strain sometimes when it comes to tax time.
Sure.
So make sure to keep that in mind. But that's how it's paid for.
Okay.
So
okay.
You don't really notice it. You pay for it every week or
every 2
weeks or every month or whatever. And down the road, it's sitting there. So then when we get to Social Security age, there's all kinds of numbers thrown out: 65, 62, 70.
Right. 66 and 10 months, all that stuff.
What do we really need to know?
Yeah. So here are the basics. It used to be 65 was the old full retirement age. They've moved that back. For most people now, that is 67.
Full retirement age.
Full retirement age. That's a technical, that's a Social Security phrase, FRA, full retirement age. However, 62 is when you are eligible to start drawing off your own benefits at a reduced benefit, significantly reduced benefit. Widows can start at 60. So if we're working in chronological order, 60 is when widows benefits can begin. That'll be a completely other podcast. 62 is when you can. 65 is when Medicare starts. For most people now, 67 is full retirement age. And all that means is I can work and earn all I want to and still draw my Social Security.
Yeah.
And then 70 is the latest you should draw. You should wait.
Right.
You want to touch on that real quick?
Sure. So you mentioned a couple different things with the ages, Dan. So the big distinction between receiving benefits prior to your full retirement age versus your full retirement age or later is you have a very strict earnings cap.
Correct.
If you receive retirement benefits early from Social Security, you can only make $21,000, $22,000 a year. It changes every year,
right?
Just a little bit. But if you make more money than that, and that's earned income, that's W-2 income or self-employment income. That doesn't count retirement income or your pension or whatever. That's earned income only. So that's a big deal. The other big difference, if you receive benefits early, That's a 5 to 6% reduction annually.
annually.
So for somebody who draws at, let's say someone had a $2,000 benefit at their full retirement age, 67. If they started at 62, they would get 1,400 a month,
30% difference.
30% discount,
Permanent.
and that sticks around. It's not like you can go back a couple years later and say, "I changed my mind."
Right.
For those folks who wait beyond their full retirement age, you can delay your credits until you're 70. That's an automatic 8% increase a year. So for that same individual, they would have a benefit at age 70 of almost $2,500 a month versus the 2,000 they would get at 67 or the 1,400 at 62. So you're talking about $1,000 difference on a monthly basis.
Permanent, substantial.
It's a big deal.
Yeah.
Now, there are reasons to sometimes draw early.
Definitely. Sure. It's not a one size fits all.
Right. Right.
So what do you see? When does it make sense to start drawing early?
Sometimes you simply need the income. Sometimes folks just say, "Listen, I've paid into the system for 40 years and I'm ready to get my benefit."
I don't know how long I'm going to live.
Right. I understand that too.
Yep.
And I think you just hit the third one, Dan, which is health can be a factor.
Sure.
If there is some type of um, terminal illness or family history of early death or something like that, sometimes it makes sense to just say, you know what, let's just go ahead and
Yeah.
turn on that benefit stream. Another one I would throw out there is if somebody is maybe highly sensitive to markets, maybe it makes sense to just say, let's go ahead and take some of the edge off and have some income coming in to help with that emotional side
Sure.
of things.
There's a it's a personal finance decision. There's some pragmatic thoughts that we don't know the future.
Right. It's not just a textbook answer.
It's not a textbook answer. That's exactly right. And would you rather have $1,500 more a month in your mid 60s or an extra $400 a month in your late 70s? Who knows?
Right.
Um, so it's a personal decision
It
for
is.
sure. And when it comes to spouses, sometimes it makes sense to hedge those bets and have somebody draw early and the higher benefit person defer as long as they
Wait
can,
as long as possible.
as long as it makes sense. That's
Yeah.
exactly right. That's exactly right.
Dan, I'm glad you mentioned spouses because there is a unique rule around spousal benefits.
Right?
So the Social Security Administration allows the spouse with the lower benefit to at least draw half of the higher spouse's benefit.
Yeah, that's right. So even if you have a spouse who never worked outside the home, that spouse is entitled to half of the benefits of the working spouse,
Right. Which provides a nice benefit.
which provides a nice benefit.
We've talked before about beneficiaries. So Social Security, it's a little bit different, but with a married couple, when the first spouse passes away, it's not necessarily that individual's Social Security benefit that drops off.
Right. The surviving spouse will continue to receive the higher benefit amount.
Correct. Correct.
Which, going back to when do I decide to pull the trigger, you have to take that into consideration.
It helps an awful lot if you've delayed one of those benefits for a period
Sure
of time.
does. Because if you lose a third, a fourth, half of your retirement income, your expenses don't necessarily go down by that
That's
amount
tough
as
to
well.
adjust to.
That's
That's
a
tough
big
to
one.
adjust to.
That's a big one.
Dan, we get asked this a lot. So, what's the crossover point? If I
Sure.
draw early,
The
if I
math.
draw late, how's it work out?
Yeah. So you can look at the math on it, and for everyone, it's somewhere in the late 70s. Somewhere in the late 70s, 77 to 80 is when the math crosses over. And that may or may not be helpful. And really what you're talking about is if you have spouses, will one of them live that long?
Right.
An actuary would tell you
Probably.
probably so. But then it goes into these other personal, do I need the money?
Right.
Do I want to defer drawing off my investments? Or would I rather draw off my investments because we've had a great market run and I'm going to let my Social Security benefits continue to cook at
Yeah.
8% a year plus a cost of living adjustment?
Yeah.
But that's getting into a little more advanced
Yeah,
strategies.
absolutely. A couple other things, Dan, I think we should note. So, your benefit is calculated on what's called the high 35. So, the Social Security Administration Simply takes your 35 highest years of income. That's all that means. Doesn't have to be consecutive, doesn't have to be the 35 years prior to retirement. They're just going to go back to when you were a 16-year-old grocery bagger to before you
Right.
start taking benefits, and your benefit is comprised of those high 35s.
Adjusted
So
for inflation.
adjusted for inflation. One thing I think that's important to note with that, that's one big benefit to working into your 60s or having some income in your
Typically,
60s.
your higher earning years
Right.
to drop off some of those lower earning
Yeah.
years.
I like to describe it. Think of a big bucket with a tiny hole in the bottom. You're draining out some small income years from the beginning, and you're
Yeah.
dumping big years into the top of that
Right.
bucket.
The other thing I'll say on that is when you get your statement, your Social Security statement, which you can go to ssa.gov and log in, that number assumes you will continue to work at your current income amount until you begin those benefits.
Mhm.
So if someone who is 58 plans on retiring and they pull their Social Security statement and their benefit is $2,500 at 67, that's assuming they're going to continue to earn for the next
9 years.
9 years that same amount.
Yeah.
Which that may or may not be the case.
That can impact the calculation.
That could impact the
Yeah,
calculation. That's exactly right.
absolutely.
What about taxes?
Yeah.
My Social Security benefits are tax-free, right?
Not right now, they're not.
It is the IRS.
That's an interesting question, Dan, because Social Security, the tax owed on the benefits is a little wonky. I think it's safe to say.
Yep.
So high level, they are taxable. As you dive into the weeds, though, it's not quite that simple. You don't have to pay a higher tax rate on your Social Security benefits. I get that question a lot. Not all of your benefits are taxable, though. And without going too deep into the weeds, essentially, the more income that you have,
Other income
the
sources.
more other income sources that you have, the larger the chunk of your Social Security benefits that will be taxable.
Right.
They'll still be taxed at the same ordinary income tax rate. There is discussion in the new tax law that's coming that the tax owed on Social Security benefits could be eliminated, but that's conjecture at this point. We don't
Right.
know that for sure.
Right. Right. I think the one thing from a practical planning point of view where we see unexpected tax liability is when people are drawing Social Security and a set amount of income, and then they need that 1 year where the car, the roof, the HVAC, they need that 20, 30 grand, need a chunk.
Yeah.
And if that comes out of a traditional IRA, if it's a Roth IRA, which we love, no big deal,
Right.
tax free. But if you pull out that extra 30 grand from a traditional IRA, that 30 grand is taxable, and it could pull more of your Social Security to be taxable as well.
Probably would.
Probably would.
Probably would. So,
Yeah, yeah.
yeah, great point to end on, Dan. I think the closing shot would be we often get asked about, well, gosh, once I start receiving benefits, does my benefit ever change? Kind of. It's
Couple
not that you
things.
jump up, and are able to receive what you would get at 63 or 64 or 65, but you do get a cost of living adjustment every year,
Sure.
somewhat in line with inflation.
Right.
Whether it's enough to keep up with inflation or not, who really knows? But you do get a cost of living adjustment. So
There's also the Medicare insurance premium. And some people will say, gosh, I got my COLA, but my Medicare premium went up by more.
I receive less.
So I receive less. Those tend to be people with lower benefits where that 2 or 3% COLA may not be enough to overcome the increase in
Yeah,
the Medicare premium.
great point.
Another good reason to defer
As long
longer
as you can,
if you can.
if you can. So if you have any more questions on Social Security basics, please don't hesitate to reach out to us on our website at lockshieldpartners.com.